Well, thank you very much for joining us today. We started off the day talking a lot about the macro environment. Larry Summers gave us some insights into the outlook for rates, whether they would remain higher, and wanted to discuss how how elevated rates and financing conditions are really affecting things on the deal side of private equity. I wanted to ask Colm if you could start us with that question. What's changed now versus pre-pandemic, pre-COVID era on what would define the parameters of a deal for you today?
Thanks. I think definitely it's changed. The days of levering to 7 times or starting with how much debt's available and then figuring out how little equity you can put into a deal is probably gone. I think more prudent balance sheets are clearly there, but it's also made people focus more on where the real value add is in a deal. If you're hoping to use leverage to really get over your hurdle rates and try and generate returns that way, that's probably not going to be a tool available to you anymore. And so it's going to be much more focused on the quality of the business and the cash flow and looking at unlevered returns and seeing whether or not the deal makes sense on a standalone basis. I think it's also going to make capital structures more prudent. In our strategy, we're levered about 4.5 times. We want the balance sheet to be an asset, and I think that's starting to be something that's sort of resonating. It's resonating with management teams who don't like the risk. They want to come out of the box thinking about growth. So I think those are the key things, I think, is a better capital structure, more focused on unlevered returns, and making sure that your management team is comfortable and ready to grow, as opposed to worrying about the balance sheet as an issue.
And Elizabeth, when you're out speaking to investors, tell us about how the denominator effect has made LPs have to think about how their commitment strategy works for private equity, and whether that's really affecting the fundraising cycle for GPs. It seems that it's more competitive than ever, or as competitive as ever, for GPs outraising capital, but the commitment sizes are in some cases not what they were. For investors in the audience, what would you urge them to consider as to how they maintain and manage their commitment strategy to the asset class?
A lot to unpack there, but I'll try. So I think, I sit in the GCC between Dubai and Riyadh, and fortunately, I think that a lot of the regional investors haven't seen the impact of the denominator effect that perhaps a lot of their peers in North America and Europe have seen, and that their private equity allocations have come under pressure vis-a-vis the rest of the portfolio. I mean, this is partially due to the fact that a lot of these funds are extremely well capitalized, and then I think it will, over time, kind of high oil prices will kind of filter into, rising allocations for many of these investors. That being said, the market is crowded everywhere in the world, whether you're looking at the Western markets, the Middle East, or Asia. And whether investors are contending with the denominator effect or just the sheer volume of managers to choose from, I think that's particularly challenging, and something that that I find is oftentimes capital is not even the constraint that a lot of investors are contending with. It's just bandwidth, bandwidth to process re-ups in existing managers, bandwidth to consider kind of new managers, and I think that this bandwidth concern is something that's ubiquitous. The easy solution may be hire more and groom more talent of future generations. But I sympathize that that's probably the hardest thing that's facing managers right now. So perhaps no magic bullet in answer to that question, but I think just recognizing the fact that the market is crowded and in some jurisdictions capital is certainly constrained, and just trying to stay the course as best an investor can is probably the best outcome.
Fanglu, I'd love to understand, are these dynamics broadly the same, both on the deal side? We had a kind of downstream and upstream discussion here. On the deal side and with LPs, are these broadly the same dynamics that you're seeing in Asia? Actually, touching upon Elizabeth's question of investor bandwidth, we're seeing allocation to funds increasingly concentrated with a handful of some of the large players like those that sit on this stage. Is that a continuation of the bandwidth issue, or are there other aspects that are driving that dynamic?
Yeah, thanks, Zachary. I think from the Asian perspective, my observations are pretty much in line with Colm's and Elizabeth's. I think both in terms of the bandwidth issue and also Colm, we had an early chat before the panel that is the understanding of the nature of long-term patient capital for private equity that is not reflected in the market sort of gyration in terms of reaction, right? So these are probably the same observations that we have found in Asia. But then the interesting thing is that if we look deeper, then there are themes that transcend the national differences or market differences. For example, sustainability, because based on our own experience, we started the ESG strategy 12 years ago, and we have found that our strategy has been able to address the fundamental demands, not only in one market, but in multiple markets. Basically, every government, regardless of its geopolitical positioning, has to provide clean air, clean water, efficient utility and transport system, right? So at the same time, we have found patient capital that understands that this investment theme actually goes much longer than the market cycle. So I think we have successfully found a place for ourselves, but then unfortunately, I'm not able to comment on the situation for every investment manager out there. Yeah.
Yeah. Some of what you said, I think, resonates in the sense that right now in a lot of Western markets, I think you're sensing less appetite for Asia. But I think from the Middle Eastern lens, there does seem to be this recognition that Asia is a very powerful geography that's growing over the long term. Whether you think about Asia as being equal to China or just Asia more holistically. And over whatever, a 7, 8, 10-year horizon, I think that opportunity remains extremely compelling. And it's thanks to the fact that investors do have this patient capital perspective that perhaps isn't as present in some Western markets.
Yeah, thanks, Elizabeth. And I would like to add that as an investment manager, then we have to prove to our investors that we can create value for them, not only in the financial returns, but also doing good things in the strategies that we follow, right? So this really means that being able to find unique and disruptive technologies, the best in class in terms of carbon emission reduction, energy efficiency, digital infrastructure, and these technologies, no matter where they come from, they can be applied successfully across different markets, as we have done. For example, we are fortunate to invest in a very unique waste-to-energy technology company originated from New Zealand, a very small market, but then their first commercial success actually happened in Asian markets because they recognized the more acute demand from the Asian markets based on the population density, the growth rate, and the previous damage done to the environment. So therefore, they actually, quite interestingly, they chose to commercialize their technology in Asian markets before the Western markets because they were able to find a faster path of approval and prove themselves. Now, having built their first commercial production lines in both China and India, and now they are expanding into Japan, North America, and also Europe, right? So the traditional sequence of commercialization, sort of from, let's say, Europe, North America, Asia, Africa, then elsewhere, right? Now it has been turned upside down by some very smart companies. And they have done this, and we were fortunate enough to find them. And in fact, we have done quite well with those investments.
Colm, across alternatives broadly, we've seen an increase in divergence between the top quartile and the bottom quartile of managers. The dispersion has become more pronounced. It's certainly more evident in those alternative asset classes where you're continuously mark to market, but certainly has emerged in private equity as well. What would you say are some of the differences between the managers that have continued to deliver in the top quartile and the bottom quartile? And is it really just a difference of those who were delivering true alpha versus those who were actually just providing levered beta?
Well, again, a great question, but you're not going to be in the top quartile unless you're providing alpha. Levered beta can get you something, but I don't think it's going to get you top quartile. Very simply, and it's the basis of our strategy. I spent 6 years in the region with Adia down the road, and it's nice to be back. And I ran the private equity portfolio for the U.S. there. We had thousands of companies. And this strategy is really based off a lot of the learnings of that in the last 25 years. And it's very simple, which is to be top quartile, you need growth. Value creation that is margin and fixer-uppers is part of you can make money doing that. But if you look at the best funds over time, it's growth. And it's usually growth in excess of 10%, usually 15% EBITDA growth. And that amounts to about 60 to 70% of where the returns are coming from in private equity. And so if you want to be first quartile, you have to find a way to help your companies grow. We're not looking for disruption. We are looking for persistence and execution. And so that's what's differentiating people. Leverage, as I said, it's not going to make a good deal great, but it can make a good deal very bad if it goes the wrong way. So take the balance sheet and make it an asset, get rid of the leverage, and look at the business, and look at whether that management team has a track record of execution and a business model that works. Sounds easy, and it is not that complicated, but it's hard to find those businesses. So they tend to have high margins, they tend to be able to reinvest, they tend to have markets that can continue to grow, and they don't have to be heroic, or they don't have to be disruptors. They just have to be very good at what they do. And so take that back. That's where we found, when I was investing in funds, the best first quartile businesses are, and that's the strategy we've been executing at BlackRock.
Elizabeth, earlier today we were talking about the changes in the global hegemonic structure with the U.S. Order being increasingly resisted. How is that materializing in how capital flows to private equity and into deals? Are you seeing a difference in capital flows, whether it's LPs from Asia investing in Western funds or vice versa? And how does the Middle East play into that dynamic?
No, great question. I'll give my Middle East perspective because that's where I sit. But I think that from the Middle East, the geopolitical and macro landscape, I think many investors have a more agnostic view. Insofar as, if you think about Europe, there's obviously a lot of, volatility, I suppose you could call it, and a lot of questions about the outlook there. But I haven't seen interest in, Europe specifically wane in the way that perhaps it has in some other geographies. I think part of this is because the MENA region is generally more tolerant of volatility. Perhaps whether it be political volatility, natural resource price volatility, whatever it might be, I do think that there's a more kind of tolerant view from this part of the world. And then as I've previously referenced for Asia, it seems like some Western investors, I think, view Asia as a monolith, and they see China equals Asia versus a broader continent. And I'm seeing that, in the GCC, most investors are actively leaning into Asia. I think, recognizing that this is a time when perhaps capital sources from other parts of the world are pulling back, yet the overall macro picture remains compelling. And I think China in particular has been identified as an area where many investors with whom I'm speaking, contrary to perhaps what my North American peers are saying, is kind of top of the priority list. I think it's a market environment that takes a lot of courage because there are, a lot of question marks out there. But I think it's one where investors will be rewarded if, you do deploy in the right opportunities going forward. I would say one thing that I do see more of is a bias towards maybe multi-regional or at least multi-sector funds. If you rewind a few years ago, investors with really mature portfolios, I think were looking for something very bespoke and specific to add incrementally to their portfolio. Right now, I think that there's benefit in having like a nimble pool of capital, whether it be across kind of sub-regions or sectors, just to be able to adapt to whatever the market has in store for it. So, interesting times.
Interesting times indeed. Fanglu, I guess that's good news for you in the Middle East that we're looking at investors leaning into Asia. Would love to understand also in your portfolio and in your investment horizon over the coming years, how the dynamic is towards investing in sustainability. We just had a sustainability panel, and there was a lot of talk about the kind of history of greenwashing investments. But what has changed, if anything? Has anything changed recently? Is this a continuation or an acceleration of a trend to make investors more serious about investing in sustainability? And why is the opportunity set, if it has changed or improved, for those investing in private equity?
Yeah, I think the fundamental understanding about sustainability in Asia has evolved very rapidly, both in terms of the political will and also the availability of public finance capital. But then our role as a private capital, I think it fits in very well within the whole picture. But then the challenge here, I think, is different from different regions of the DLPs there. In North America, I think people tend to be more concerned about the top-line news that they read, and also that filters into their decision-making. In Europe, I think it is because the regulatory framework is probably more developed than the other regions. So then they apply the measurement more stringently than the other markets. Then Middle East here, and I have had the opportunities to talk to multiple investors here. I think I agree with Elizabeth's assessment that they are more willing to listen, but then the bandwidth is a challenge. So let's say for the strategies that we are interested in, my assessment is that first of all, the LP has to have enough size of the capital to be deployed, but then they also probably will be better served to have a dedicated pool for sustainability. Because if we are putting in a big pool, then the bandwidth issue is going to factor in very quickly. So for us, in terms of finding the right investors, then I think more and more smart investors are allocating certain specific pools of capital for sustainability. Of course, greenwashing happens everywhere, so it is incumbent on the managers to prove themselves that they have done enough to help the portfolio companies and the regions they are in terms of developing the standard. But then, if you want to say that in all Asian markets, the reporting standard or practice are at the same level of Europe. I'm not sure about that, but then at least the progress has been very rapid, and we are part of it. So it is for the investors to understand whether they want to wait for us or wait for the market to be at the same level, or be part of the transition. So fortunately, I think there are investors that are willing to do that.
Colm, you were previously part of an allocation behemoth to this asset class. What would you say to some of your former, not only colleagues, but those who are sitting on the allocation side in general about managing their commitments to private equity as an asset class, dealing with the denominator effect, dealing with how they operate in an environment where there's demands for their liquidity across their portfolio? Is now a time to stay the course? Is it time to potentially increase allocation? Is it a time where considering secondaries or other options for getting liquidity out of your private equity portfolio is more challenging, or is that an option? We'd love to understand. There are obviously many other institutions and organizations that deal with much different dynamics. Pension funds that are very underfunded have a completely different set of challenges than the Abu Dhabi Investment Authority, which continues to accrue and accumulate liquidity from the sovereign.
Yeah. Well, there's a lot in there, and it is a favorite topic aside from what I do on my day-to-day job. But stay the course is probably the headline, but everybody's course is different, and everybody has to make adjustments. Everybody has, as you said, different constraints. Some of the entities we talked about here don't have any actuarial liabilities. Some have real liabilities. Some have family issues. So everybody's got a different issue. I think the key is that in the lessons learned from my experience and from that institution I was with, was avoid pro-cyclicality. That's how you give up most of the returns in private equity. Overinvest in the hotter periods, underinvest in the not so hot periods. And so having a strategic asset allocation and what I would call a flight path of where you want to go with some guardrails around that so you can toggle up and toggle down makes sense. But turning spigots on and turning spigots off is not an easy tool, and it's not an advisable tool in the private markets. When you sign up for a fund, you're really signing up for a relationship that's going to be 10 years minimum, and then in 3 years or 4 years, somebody's going to come back and ask you for more money, and that's going to happen again every 3 years. And so you're really signing up for a 10 to 20-year relationship. And the data would tell you probably don't know where returns are going to come out in a fund until well past that first 3 years, probably 5 or 6. You have good indications. So to toggle up and down is very difficult to get in and out of those partnerships. It's hard to get back into a partnership if you start to build a reputation that you are going to pull out, somewhere in the middle of that arrangement. So I think you have to be just very balanced in how you think about it, but you can increase up and down. That's why a lot of institutions have gone to sort of co-investment capabilities or sidecars, because it builds in some flexibility to do that. So that's one reason to be a little bit more of a self-determined investor rather than just be on that capital call runway. But so I would say stay the course, but have some flexibility and recognize that the market today is probably when some of the best deals will get done. These vintages tend to be vintages after corrections tend to be the better vintages in time. So if you miss them, you miss a lot of what people are looking at when they say private equity is a good asset class over 20 years. So balance and stay the course.
Colm made a perfect segue into a point that you and I were discussing on our call, Elizabeth, regarding co-investment and the appetite for allocators the appetite and capability for allocators to do more direct deals. Now, what are some of the things that you see driving this dynamic generally? Is it just about fees? Is it a lack of or disappointment in performance of some of the managers those organizations have allocated to? And what are some of the differing dynamics that you have here with these sovereign allocators whose mandate goes beyond just returns, and where they see other benefits from dealing directly?
A good question. So I think if you rewind maybe a decade, I don't know what the appropriate time frame is, but I think a lot of the co-investment discussions originally were born out of, trying to reduce the overall fee burden. But in conjunction with that, over time, many institutions have really built phenomenal direct investment capabilities. And I think want to flex that talent, frankly. That being said, there's a limitation that if you sit within the GCC, it's pretty difficult. I mean, Colm would have more perspective on this, but to truly source on a global basis the best deals. So I think working alongside an existing manager to source co-investments is kind of a good, I think, happy medium insofar as capturing deal flow while being able to reduce your overall fee burden. Increasingly, though, I see co-investment and direct deal appetite driven more by learning, and that's I think, as I had referenced before, you do have this bench of talent within these organizations with those capabilities who are really looking to kind of refine their own skill set in understanding of a particular sector or deal type. And for example, KKR has a global impact fund, and we've started having some very meaningful conversations and commitments from investors in the region. And it seems like there's just a lot of curiosity to co-invest as a way of learning about what's really a new area. And then as an extension to that, potentially bringing some of those ideas and capabilities back to the home country, whether it be the UAE or KSA or wherever the particular institution sits. But in short, I think co-investments is becoming increasingly about learning and trying to, when appropriate, import some aspect of the deal back onto the home turf.
Yeah. I'll give you two other elements from my experience. One, if you want to know somebody, do a deal with them. So it was actually a great tool to get to know a partner. Everybody walked into our office and told us they did 20%, and I can make any spreadsheet say 20%. But the question is the distribution of returns, how they think about risk, how they think about the various outcomes, and what their underwriting is like and what their diligence is like. So when I came in 2012 to build out that team, that was really, element number one. The other element, it wasn't about fees for us. The other thing that is happening and was really the primary driver, is alternatives are growing in everybody's basket. It's harder and harder to put money into blind pools that you don't know what you're going to own until 5 years later. Okay, because you don't know, if you give me some money, what I'm necessarily going to invest in. What a co-investment and a targeted co-investment program does for you, if you have the capability, is it allows you to sort of be a little more tactical about weight. If you decide you want a little more healthcare, you can double down on a healthcare deal. If you want a little more technology, you can double down on a technology deal with the people you think are the best partners for that. So it becomes another tool in your toolkit for your asset allocation in that area. So partnership and understanding your partners, and then giving yourself one more tool to do it. You need the skills to do it, and wouldn't do it blindly, but it's a journey.
Fanglu, we are a little bit over time, but I did want to ask you about this topic. Do you see a similar dynamic in Asia? I would presume that given it can be a more difficult environment in which to do deals, it can be more require skill sets and local knowledge that may not be as easy to hire in-house, that the push towards direct deals and maybe to a lesser extent co-investments by large institutions may be less pronounced than it is in the West.
Yeah, thanks. I agree with the observations just made by both Colm and Elizabeth. As investment manager, we have to prove ourselves, our value to our investors. Yes, in some investment strategies such as sustainability, I think we do have the wind in our back from the, let's say, the political will and also public finance. There's a lot of capital, but then we still have to prove that we are able to find very interesting opportunities for our investors. And so our anchor investing in our new fund is a DFI from Asia, and they clearly recognized our value in terms of helping them finding the investment opportunity, and also for their lending business, which is their main business, right? So they use us not only just as a vehicle of a capital enhancement, but also opening doors for their main business. So no, I think we have to prove to every party that we do add value to them, right? So then that is the most important thing. So it is, talking about the fees and all the sort of economic, then it is, in my opinion, a demand and supply issue. So if we are proven to be one of the sort of investors that can provide financial returns and do good things at the same time, then I think the conversation will have different nature.
Well, thank you very much. I apologize to everyone in the audience for going over time. This was such an interesting discussion. Such a pleasure for me to have your time and for you to share your intellects with myself and with the rest of our audience today. Thank you so much.
Thank you very much.
Thank you.